Okay, hey everybody, this is Brian, and here we're going to do a little bit of a follow-up and talk about the micro-mechanics of the marketplace. Obviously, in other videos, you've already learned about how the markets move and how we utilize that in order to give ourselves an edge when we're trading, especially using the complete currency trader method of trading. As you know already here at Forex Made Easy, my main trading method is with complete currency trader. This is what I use, and this is a very big part of my life. And as a matter of fact, I do run the live training rooms for James Edward, who is the creator and founder of Complete Currency Trader, and I run his live training rooms a couple times per week for the members. And a lot of the videos that I put up here, some are fresh videos that just of topics that I think about during the day, but others are very largely impacted by the trainings that I do with Complete Currency Trader. So I like to share that information here on the blog and just make sure it's something that you guys can learn from and utilize in your own training, and hopefully will get your wet your whistles, as I like to say, for some more information about that and how you can become part of Complete Currency Trader. We have a lot of free training on our website, and I'd love for you to be a part of that. Down at the bottom of the page here, you can obviously click and enroll in the full free membership for Complete Currency Trader and get even more detail than what I'm giving you here, and learn about some really cool trading methods from James that will allow you to utilize parts of the Complete Currency Trader system so that you can apply those into your own trading and start seeing success, and hopefully eventually come on board with us as a full member. For now, I'm going to talk a little bit about the market mechanics, the microstructure of the market. This builds on one of my preliminary videos where I talked about the edge, the trading edge, and I feel like this will give you some more information and help you learn more about trading successfully and trading with what's actually occurring in the market versus trading against it. Now, before we get started, as always, I have to let you know that trading does involve risk. It's not for everyone. There's a high degree of leverage that can be used within the Forex trading, and that can work for you and against you. So it's important that you understand your investment objectives, that your risk appetite, never trade with money you can't afford to lose. Things I really shouldn't have to tell you, but I guess for whatever reason legally we do to protect people from themselves. So anyway, that's a whole topic for another time. If you'd like to read a full disclaimer, you can. You can go to CompleteCurrencyTrader.com /disclaimer. I think I always have a disclaimer on this website that you can click on and review if you need to be reminded of the fact that trading does involve risk. So anyway, let's jump into it. And again, this is something that I taught in a live room in a class, and we're just going to do part of it. Obviously, the first part of this is very, very in-depth. This is the 30,000-foot overview where we'll cover some topics that maybe weren't covered in some of the basic videos that I've put out here. So anyway, we've already discussed in other videos how prices can move and how they do move significantly without anyone actually buying or selling, without any kind of an actual exchange. This is because the prices that are quoted on the platform are the prices in which the market makers are willing to trade at, where their future trade opportunities might exist. They're not actual past trades. These are the prices that the buyers and sellers are willing to trade at. Remember, the Forex market is an auction market. It's not a transaction market. It's an auction market. So just like an auction where prices can move without the transaction being completed, that's the same thing that happens here. We've got the market makers putting prices out of where they're willing to buy or sell. Those are with pending orders, and that, of course, is what shows up on our platform. The dealer can remove their orders. They can widen spreads. There's a lot of things that can happen out there, and to that end, we've got prices that can be changing without trading taking place at all. So today, what we're going to get into is a little bit more about that. We're going to talk about order types. We're going to talk about the orders that we place in the market and how they can have significant repercussions on our profit, on our loss, on our risk, and understanding how each one behaves is very, very, very important to us being able to trade more effectively. So we know that we've got three different types of orders at our disposal. We've got limit orders, we've got market orders, and we've got stop orders. So we're going to dig into each of those and give a bit of education around them so that you can keep learning and keep growing your Forex education. Now, first off are limit orders. So what is a limit order? Well, it's an instruction to trade at the best price available, but only if that is equal to or better than the limit price that's specified by the trader. This is an order that provides liquidity, and so therefore it provides other traders an option to trade, right? If we're placing limit orders, we're basically at some level a market maker, right? If we're placing limit orders, we're putting liquidity into the marketplace. So some practical uses of limit orders. Well, they're specifying the exact price at which we want to trade. We don't want to trade above that or below that. We want to trade at the specific price. The cool thing is it's not possible to experience any kind of a negative slippage when using a limit order. The order is only triggered if and when the market reaches that level. So pretty good stuff, right? There's advantages though and disadvantages with it. The advantage is the cost of trading is reduced because we're able to get in at an exact price. It gives us better prices with lower transaction costs, and we'll never experience negative slippage. The disadvantage is that we don't know if we're actually going to get in, right? There's an uncertainty to the actual execution of that trade, and a lot of times it has that posting regret that can occur. Another disadvantage there, and what that is that's an instance where the order may be executed and filled, but then the market moves against that new position, and we kind of have some regret about placing that limit order, and because in order for it to be profitable, the trader needs to be successful in trading the opposite direction of the current market's momentum, the current opposite to the current trend. We kind of actually have to call that price turning point in order to be able to get into the market with a limit order with very low risk or with very low cost and exposure. So there's advantages and disadvantages to that. Next up is the market order. The market order is an instruction to take a trade at the best price that's currently available in the marketplace. Market orders are used by impatient traders. I know impatient, and I'm kind of using air quotes that you can't see, obviously, because it's just my voice. But impatient traders, the word impatient doesn't have any negative connotation. It just simply means that the traders want to get in right now. So an impatient trader would be using a market order so that they can get into the market right now. They want to be certain that they're able to take a trade. So market orders consume the liquidity that's out there. And the execution of that order depends on the size of the order and current levels of the available liquidity. The person that's submitting that order is announcing to the marketplace that they want to trade no matter what. We want to trade at all costs, and we're going to take the best quote available no matter what price that is. Now, again, there's some advantages and disadvantages to that, but end of the day, market order consumes liquidity, and it will take our best bid or offer that's being quoted from the dealers right now. Now, when liquidity is high and the market order is small, the transaction happens almost immediately, almost simultaneously, and that's often taken for granted because, as we know, as we get later into the day, or maybe during periods where there's not as much liquidity out there, it can take more time for that to fill. We can also have slippage, right? If the market's really moving very, very rapidly, we want to get in at a specific price. We hit that market order. If prices, if the liquidity is being absorbed very, very quickly, we could experience slippage against us. So maybe we're trying to get in to, the Euro USD at 128, and the market's moving very rapidly, and it hits 128, and we hit that order button, but by the time the market actually executes the order, price is down to 127.92, just hypothetically, right? But we could have that kind of slippage occur in a very, very fast-moving market. So remember, market orders are instructions to trade at the best price that's currently available in the market. They say nothing whatsoever about a specific price. It's only the best price that's currently available. So an example of that, we've got normal market conditions. We've got the bid and the offer. It's a very tight spread. but then suddenly the the liquidity dries up or volatility increases, we can see that spread widen, and that would that would cause the you know trade to maybe be against us, or get in at a price that's very different from what we had expected when we first hit that button. Advantages, disadvantages, both of those order entries have both advantages and disadvantages. The best thing here is just to keep a balanced understanding about it, because when a trader is certain that they see an opportunity and they want to trade, a market order still guarantees that, but doesn't guarantee us the price, which a limit order can guarantee us a price. So there's a flip side, but when being in the market is more important than the price of the entry, then of course the market order is a preferred option. A limit order can very easily miss that market price and then lose the trading opportunity. So yeah, it just depends on your trading goals, what you would rather use. We're not saying one's better than the other, just trying to give some education about what is out there and how they're used. Next up would be the stop orders. A stop order is an instruction to execute an order until the price is reaching a specific level that's dictated by the trader. The trader might use a stop order when they want to buy only after a price has gone to a specific level, or maybe they want to sell when a price falls to a specific stop level. I mean, most frequently, stop orders are thought of as quote stops. We have a market, we're in the market and we're protecting ourselves, so we enter a stop order, that so if the price goes X number of pips against us, it stops us out. That's what people most commonly think of. But a stop order can also be used for breakout type trades. If we're waiting for a price to break through a specific level before it's executed, we would use a stop order at those specific levels. So it can be used in two different ways. Commonly, though, associated with our actual protection, but can also be used in other ways as well. The thing to really remember, though, about stop orders is the stop order actually becomes a market order. So price moves to a certain level, and then it's executed at the best price available once that level's been breached. So, if the market has a lot of liquidity in it, it's not moving very rapidly, that stop order could be executed almost immediately at the price that you're looking to get in at, or even quote out at if you're looking to use it as protection. However, do keep in mind it is just simply an entry point. So if we've got a stop order at a specific level, price is moving rapidly, it moves through that level, then the stop order could be executed telling us to get into the market at a specific time, and at that point it's saying just enter the market no matter what. Now that price has been breached, it's basically executing it as a market order. This is confusing for some people when they're placing stops in order to protect themselves, because often they'll think, well, I've got to stop at, again, just using a round number, 1.28, $1.28 on the Euro USD. I have a stop order there. So they think, well, if price, is moving very rapidly, let's say it's during non-farm payroll, and price is moving rapidly, and bam, it hits my stop order, I should be out at 128. Well, not really. If price is moving rapidly, liquidity is being absorbed very quickly, you may not get out until 127.90, 127.88, whatever it might be, because your stop order is being triggered, and then it's saying, enter, I want to have a market order at the best price now that price has hit this level. It could work for you as well. It could obviously hit that level and bounce up as well, and have positive slippage for you. But just keep in mind that it is entered as a market order once that level has been breached, and can work against you just as well as it can work for you with that stop order. So just keep that in mind. There's some level of uncertainty that can go both ways on those things. So how does that work? How do we put it all together? Well, we've got to think through depth of market. We've got limit orders, stop orders, market orders. So as a trader comes in and takes liquidity that's being offered at a level, the best market price available for the next trader to take naturally has to be the next nearest offer, either that's higher up. So as those things are subsequently taken, price is moving. And that's how all of these things work together. The limit orders provide liquidity. The market orders absorb it. Stop orders are basically market orders that are also absorbing liquidity and causing prices to move. So in reality, we've got prices on both sides of the market, and the price is going to follow the demand. If if we have the example that we had used earlier, if it was to play out in terms of buyers coming in with market orders and consuming the liquidity on offer, then this would keep forcing the market higher and higher and higher as we're consuming that liquidity. And that could also happen if there's, let's say, a stop order here. We have a lot of stop orders, but we also have people that are buying it. We have buy stops, so maybe people are looking to sell off down here, and the market's moving against them. It moves up, hits this certain level. It causes causes liquidity to be absorbed through market orders that are being put in because the stop was hit and it executed a market order. It takes that off. Other buyers are coming in, and it's just causing price to go, and that's how the market is moving. So the examples and the illustrations that we've used should raise a fair number of interesting points and observations about price movement, which is what we've been saying in all of our previous videos, that price has a tendency to move in the direction of the least liquidity. It has the direction to move in the direction of the least resistance. So what that means is that even if demand is equal on both sides of the market's going to move in direction of whichever has the least depth. And that's exactly what our principles of trading, when we're talking about Complete Currency Trader, are based on. Price has already started to change. It's already started to move based on increased demand from a certain side, whether it's the buy side or the sell side, it doesn't really matter. Price has started to move and change due to that increased demand, and we're able to see that using the tools that we use for Complete Currency Trader. And as that happens, it's going to have a tendency to continue kind of cascading, because as it begins moving, we have the dealers that are reducing their risk, they're reducing their liquidity so that they don't have as much risk to that one side, and then that's compounded because we have the buy orders that are being triggered as price is reaching those orders, which is absorbing that liquidity. Liquidity is being reduced, it absorbs more liquidity. Liquidity is being reduced, and the price just keeps cascading. It's kind of a self-perpetuating cycle, and that's what we capitalize on with Complete Currency Trader. So I hope this has inspired you to learn a little bit more. It's very, very interesting how the market mechanics work, how the micro mechanics of the market work, and these are things that are fundamental, repeatable mathematical probabilities, and this is what makes sense in the markets. And knowing this and understanding how it works is something that allows us to trade successfully over time. And I'd like you to click that button below this video, go over to Complete Currency Trader, our main website, and register in for there, and get registered in to the to the free training, and learn some more with James. And like I said, James, who's my mentor, and I also teach classes for his students. It's an incredible thing. I'd love for you to go in and learn more about this, learn more about trading, and sign up for our free education where you can actually learn a very basic trading method from James that will allow you to start seeing some consistency in your trading, and hopefully help you start growing your accounts using a very, very simple method that's very duplicatable and repeatable. So there you have it, and I'll have some more videos out for you very soon. Have a great day.